Welcome to Talk Tickers. Today, we are breaking down the Q4 earnings for South Plains Financial. That's ticker SPFI. Now, they reported after the bell, and the very next day, the market, well, it had its say. On the surface, the numbers looked pretty good, but the stock reaction told a totally different story. So let's dive in and figure out why.
And there's the verdict, a slight dip. The stock closed down just under 1% the day after they announced. So the big question is, why the kind of lukewarm reception? Especially when, at first glance, the headline numbers looked pretty decent. What did the market see that wasn't immediately obvious?
And here's where it gets a little complicated. You can see South Plains beat earnings per share estimates by a solid 6 cents. They reported 90 cents when the street was looking for 84. That's great. But they came in just a little shy on revenue, missing the consensus by about $230,000. It's that classic beat and miss scenario that, it just leaves investors scratching their heads, trying to figure out the real story.
So to really understand that hesitation from the market, we've got to start with the story management was telling on their earnings call. And let me tell you, despite those mixed results, they came out swinging with a really confident and positive message.
Yeah, this quote from CEO Curtis Griffith pretty much says it all, right? He immediately set a positive tone, saying how pleased he was and crediting the bank's culture. This was not a management team making excuses or sounding worried. They were on the offensive, for sure.
And they really hammered home 4 key points to back up all that confidence. First, they pointed to a healthy net interest margin, the NIM, which is basically the core profitability of their lending, and it hit that 4% mark. They also showed strong growth in tangible book value per share, a key measure of a bank's real intrinsic worth. On top of that, they highlighted a nearly 18% jump in full-year earnings, all while keeping their quarterly dividends steady. So the picture they were painting was one of real, fundamental strength.
But honestly, the real story here, the thing that's going to define their future, it isn't just about this last quarter. It's all about a massive strategic move they're making into one of the hottest markets in Texas.
Yep, we're talking about the acquisition of BOH Holdings, which is the parent company of Bank of Houston. This is the absolute centerpiece of the whole investment story for South Plains. And look, this isn't just some small, minor tuck-in deal. No way. This is a transformational move that's designed to add some serious scale and really hit the accelerator on growth for years to come.
Management basically broke down the why for this deal into 3 really clear steps. So first off, it adds immediate scale. We're talking over $600 million in both loans and deposits, just like that. Second, it's expected to be a big boost to the bottom line, driving earnings per share up by around 11% by 2027. And finally, the payback period is fast. They expect to earn back the tangible book value in under 3 years. I mean, on paper, that's a really compelling case.
But of course, no deal comes without risk, and the overall environment for regional banks right now is, let's just say, challenging. So this is where we have to read between the lines of the Q&A session on the call to really understand why the market is being so cautious.
So this is the million-dollar question, isn't it? If the math on this acquisition looks so good on paper, what are the headwinds that are kind of putting a damper on all that enthusiasm right now?
Well, it really boils down to a few key worries that kept coming up during the analyst Q&A. First, there's just intense competition for deposits everywhere, and that's putting pressure on how much banks have to pay for their funding. That flows right into the second concern, protecting that all-important net interest margin. On top of that, management also flagged that they expect some loan payoffs in the first quarter, which could slow down growth in the short term. And finally, you've always got the risk of just making it all work, right? The execution risk of bringing a major acquisition into the fold.
Now, one term you probably heard on the call is deposit beta. It's a super important piece of jargon right now. Think of it this way. It just measures how quickly a bank's deposit costs go up or down when the Fed changes interest rates. With rates potentially coming down, you want to see your costs fall fast, but all that competition can make it really tough.
And management actually put a number on this. On the call, they said they see their deposit beta sitting in the 30 to 35% range. So what does that mean? For every 1% cut by the Fed, they expect their own deposit costs to fall by about 0.3 to 0.35%. And that number is absolutely huge for grounding that abstract risk in a concrete forecast that investors can plug into their models.
Okay, so let's put this all together. What do we have? We've got a solid quarter, a really transformative acquisition on the horizon, but also some very real short-term headwinds. So what's our final take? What's our analysis and rating?
All right, here's our call. For the next quarter's results, we see them coming in line with expectations. But those loan payoffs that management mentioned, That's likely going to be a headwind to their net growth. Because of that, we expect the stock to be pretty range-bound, kind of stuck in a holding pattern for a bit as investors wait for more clarity on how the acquisition is going and where margins are headed. This leads us to a market perform rating. Look, the long-term potential from this Houston deal is significant, there's no doubt. But for now, it's balanced out by those industry-wide pressures, which justifies a neutral stance.
And as always, just a reminder that this analysis is for informational purposes only. It is not financial advice.